Is it safe to invest in the stock market right now? I hate to give this answer, but it's a loaded question. And the answer is, it depends. On this channel, we do a lot of investing. We do a lot of different ways of making money. We invest in value stocks. We invest in real estate. We invest in businesses. We invest in options. We trade monthly, daily, week. So we don't believe there's one way to make money. We believe there's multiple ways to make money, but it has to speak to you. Now, is it safe to invest in stocks? Well, let me ask you a question. Are you 25 or are you 70?
Great question.
That's the first question I'm going to ask you. How old are you? Well, why is that? Okay, well, if you're new to this channel, I talk a lot about the stock market to GDP ratio. This is a metric that Warren Buffett considers the most reliable metric at any given time to show where we stand in terms of stock market valuation. I created my own based on the S&P 500. A couple people in our community up here have emailed me to ask how I did it. And it basically very simply is the S&P 500 is a market cap based index. So all I have to do is take the S&P 500 and basically add a couple zeros to it and I can make it its own metric. The bottom line is it doesn't matter what it is as long as I come up with some consistent ratio. We're currently at 1.536. Now, in and of itself, that means nothing to you. Well, what does that mean? Well, I don't know. I mean, is it good? Is it bad? We have no idea. Mo, do you think it's good or bad? Well, you know the answers.
I'm trying to play along here.
Yes, he's trying to play along, but the point is he knows the answer. Well, I go back to the S&P 500, going back to its equivalents back to 1929. And this is data I got from Schiller over at Yale. The historical average is 0.929. So we're at 1.536 and the historical average is 0.929. That is overvalued by 65.3%. Going back to 1929. Okay, so it screams overvaluation. Could there be a reason for that? Well, rates were down for a long period of time. They were near zero. It was low rates drive up stock prices, etc. So I want you to keep along with me, but if this sounds confusing, don't worry about it. Just keep watching the videos. It'll make a lot. What was that?
It's confusing. Don't get discouraged.
The first time I heard it, the second time, it took me a while to understand it. But once I did, it helped me fear stock prices way less. Like I don't even worry about stocks. Like the other day, Tim was in my office and the market was up a ton and my stocks were down because I have a short on the NASDAQ. He was like, this doesn't worry you? I'm like, zero. Like literally, and it was a significant money I was down.
It's a long-term approach.
Yes, because I know what the long-term means. I know what's going to happen in the long term. So if you're at retirement, this should worry you. Because historically, not including dividends, going back to 1929, looking at every 10-year rolling average, the market does 6.6% a year on average, not including dividends. You include dividends in there, it's about 10%, but we're just comparing market index. When we're undervalued, the average is 9.3%. When we're overvalued, the average is 2.3% a year returns for 10 years. But here's the scary part. When we're 30% or more overvalued, remember, we're 65 currently, it's a negative 0.1% per year, not including dividends for the next 10 years. And it makes sense, guys. This is logical. The more you pay for a stream of cash, if I'm going to give you $1, $2, $3, $4, $1 next year, $2 second year, $3, $4, and ask you to pay me $10 for this, are you going to do well? No, you're going to break even. If you paid $5 for it, you're going to do well?
Yeah.
If you pay $30 for it, are you going to do well?
Terrible.
You're going to lose money. The more you pay for an investment, the less return you make. It's very intuitive. The more you pay for something, the less your return. So the more you're paying, the higher the ratio, the lower your return should be. So it makes complete sense. So back to our original question. Is it safe to invest in the stock market? Well, if you're 25 years old and you're going to retire in 40 years, let's look at the history. The S&P right now is at 3,941. Let's go back 40 years to 1982. Where was the S&P? 132. Right?
I thought it was going to be higher than that.
No, 132. It was the August of 82 was the low of the market. It was at like a 117. Guys,
incredible.
Let's go to bad times. Let's go to the peak of that. So the S&P was flat from 1966 to 1982. So if you bought at the peak in 1966, you paid, the S&P was, let's go back here. Let's call it actually hit 110, but for our data here, let's call it 95. Let's go up 40 years. 1967, 40 years extra is 2007. Let's look at 2007, right when 1500.
Yeah.
So even if you paid at the peak of that market, you went 40 years, your number is still 16 times higher.
Do it even September 2008. Look at that one, 968.
Yeah, the low 848. You're still up 8 or 9 times your money.
Exactly.
Now, let's say you're 70 and you retire tomorrow. Okay. I mean, things can really fluctuate on a year-to-year basis. And if you need to rely on that money to grow with the S&P in retirement, you're going to have to know that this means one thing. The market's probably going to go like this, okay? And that can be scary. However, if you dollar cost average all along the way over the next 10 years, you're going to pay this, and that's how you make your money. You can still do well and make money as long as you have the emotional fortitude. Mo, go ahead.
If you're 70 and you are scared of investing in the stock market for these reasons, I mean, we are paying some great treasury yields out there nowadays.
The 3-month treasury is 4.29%.
Right here. I mean, if you want to go, what's the highest? 6 months, 4.68%. And this is basically risk-free. I mean, unless the government goes under.
Listen, if the government can't pay your 90-day treasury,
don't worry about your retirement.
First off, the S&P is at 4. I mean, there's going to be major issues.
Exactly.
So just like everything, is the S&P safe to invest in today? Well, if your outlook is a long time, decades, yeah, it's perfectly safe. Now, are you going to have some bumps along the way? Absolutely.
It's going to be.
I believe the S&P's fair value currently is around 2,300. Does that mean it's really 2,300? No, it just means this is an average. Could it be 2,000? Sure. Could it be 2,800? Sure. But the bottom line is it ain't 3,900.
Right.
So you have to be ready for fluctuations in the market as time goes on. This is a good thing. I'd rather have you understand this now and get this understanding. That way, when it does happen, you go, yeah, but my plan is X amount of time long. But if you're 70 and you need this money to be invested in the S&P in order to live through your retirement, I would urge you to be cautious. It's probably going to be a tough road. Is that for sure? No. But the correlation between this value and returns is negative 0.81. What does that mean? The most inverse correlation is -1. This is a very, very strong inverse correlation. The more you pay, the less your return. This is extremely strong correlation. So this basically means that the next 10 years is going to be bumpy. Does this mean we're going to make -0.1? No, we could do -3. We could do +3. The bottom line is it probably ain't going to be 6.6. And that's the key here. And there's going to be a lot of volatility involved.
Yeah.
When you're at these major levels of valuation, you're going to have a lot of volatility. Look at this year alone. We started the year basically at 105%. The ratio was 105%. And look at this year.
And we're at 65 now.
And we're at 65 now. And look where the stock market's gone. It's been like this.
Yeah.
It's been this. And guys, you've watched our videos, and I'm not trying to put fear in you. I just say this is the world in which we live. My job is to sit here and say, what do I see, and what does that mean about the future? But I'm not going to change my parameters for investment just because something might be over underpriced. I have to get in the game. I want to teach you through this channel the emotional fortitude of staying safe and saying, okay, the long run is going to do well. 1966 to 1982, stocks went this way. 2000 to 2008, stocks went this way. Sorry, 2003 to 2000, because actually stocks went from 2000. How long did it take from 2000 to even get back to even? So it peaked in 2000 at 1999 at 1468 in June of 2000. Next time it hit there was 2007. And then from there, next time it hit there was 2012. So from 1999 to 2012, it was flat.
With a lot of
volatility involved.
Yep.
That's 12 years. And by the way, if you go look back at this metric, 1.029, it actually wasn't that overpriced based on history. Right. The big overvaluation has come in the last 20 years. Market has been very, very overpriced. So guys, if you like this, subscribe to the channel. You're going to have a lot to learn. It's going to be awesome, and it's going to make you feel better. I guarantee you. Thank you very much for your time.